Inflation remains the key focus for investors, pretty much the same for the Fed as they continue to react to lagging data such as CPI and, of course, jobs. In this environment, where are the opportunities for investors like yourselves? And, of course, where are the risks? We're going to discuss that and more on UBS Trending. Hello, everybody, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thank you so much for being with us. Jason Brady is my guest today, President and CEO of Thornburg Investment Management. Jason, good to see you. Thanks for joining me in the studio.
It's great to be here in the studio.
Yeah, we've only done the virtual thing up till now, so it's good to see you in person.
Yeah, likewise.
And by the way, I want to get right into it with you. We had CPI report come out, and it was a really interesting report. Obviously, we're all tied into inflation and where we're going, and of course, that translates to what we think the Fed will do. What did you pull out of that CPI report? Because the core number came in at a rise of 0.1%, which was just a little bit below expectations, but still showing a rise year over year.
Well, the core number also is now higher than the headline number,
right?
Which really shows that the inflation is more broad-based than the Fed would like, I think, than investors would like. When you take out certain components, again, you can slice and dice this a million different ways, and inflation at the end of the day is everything. But when you look at what is likely to continue to push inflation through or not through the next 12 months or 24 months, the core ex-shelter still came in at a relatively elevated number in the mid-fives year over year. So there's a lot more wood to chop.
And it's interesting in that core number, it looked like energy actually was part of the reason why it was a little bit lower, but they said things like car sales were lower, but what were the things in there that were starting to actually give the number that bunch of a boost?
Well, it's really passing the baton from goods to services. So earlier on when inflation numbers were higher, it was a result of goods. There's a lot of talk about supply chain restrictions. Now that's not the issue, right? Goods aren't falling. As you say, used car prices was a big number. Now that's negative. But services really are persistently higher. And the risk there is that what you're getting is a wage price spiral beginning.
And housing, too. That was still a big part of that core number as well.
Housing is extremely important, right? So, with the sort of whole shelter component's about a third of CPI, more or less. And it's also enormous within the services component. So when you look at shelter costs, the thing about that is, speaking of lagging, that's sort of lagging within the lagging CPI.
That's right.
And when you go and you look to rent an apartment or what have you, the imputed number there definitely doesn't keep up with sort of what's currently happening on the ground. That's one reason, not that it's not important, but you can remove it. It's not as forward-looking. But it continues to be high. I expect it to come down. But ultimately, just from base effects, and if we continue where we are today, sort of that momentum, we're going to be in the midsummer about 3.5% on inflation. More decline from there will take something different happening.
Well, I mean, at most expectations are the Fed's going to go another 25 basis points, a hike in May. I'm imagining that's where your head is sort of thinking they're going to head this way, right? And then maybe they'll halt for the rest of the year. But the question then remains, when do they pivot? Are they going to hit that 2% inflation target anytime in maybe mid-2024? It almost doesn't seem likely at this pace. But maybe you're seeing something different out there.
Again, if you take the economy as it looks like it is today, and you say nothing's going to change for the next year or 2 years, then it's going to be very difficult for the Fed to hit that 2% target anytime soon. I do think the Fed's going to raise 25 basis points. I think they've communicated that. They don't want to surprise the market. I think they should sometimes, but they don't want to. And so 25 basis points is probably in there. But that kind of doesn't matter. What really matters is, as you say, how long are they going to be at this current level of around 5%? The Fed's track record is one, partly because it's hard to drive a car looking backwards. As you say, inflation's backward-looking, employment's backward-looking. The Fed really struggles to get that number just right. That Goldilocks number is very elusive, and I don't think this time is going to be any different there.
Do you think we're on the road to a recession is the question? I mean, we here at UBS at CIO think there will be, but certainly not at the depths of what we saw, certainly during the financial crisis.
The financial crisis is sort of our last sort of financial recession. Obviously, we had a recession in 2020.
That's right.
It was an exogenous event, and it was solved by another exogenous event, so the pandemic and a vaccine. But looking at a potential recession, yes, I think that's going to happen. I think you are seeing some things break, but the consumer is still pretty strong, and the consumer is a big part of the U.S. economy, a big driver of how deep a recession might be. if you're looking for an analog, I'd say it's more 2001 than 2008. Now, the joke is that it's a recession when your neighbor loses their job. It's a depression when you lose yours. And I'll tell you, I got laid off in 2002, so that was a depression for me. But actually, economically, it wasn't really that bad. There wasn't that big a job loss,
Right.
and that's sort of a better analog for
Yeah,
me.
that's interesting. I think a lot of people who are watching this experience that kind of job adjustment, you'll say, in various periods between 2001, 2010, 12, depending on whatever crisis you were a part of. Putting your bond hat on for a second here, obviously rates, when you look at the benchmark 10-year Treasury, what an interesting ride. And even with the CPI print today, we saw about a 10 basis point decline in yield. So we've got equities rallying off that number. We've got bonds rallying off that number. Where do we go from here when you're looking at, especially yield curve inversions? It's telling us that there's a recession coming, but where do you see the opportunities in fixed income right now?
So I think 2022 was a rocky ride for a lot of folks, right? And talking to clients, including UBS financial advisors, a lot of folks hadn't experienced that level of volatility in fixed income. And the good news is where it brought us is a much better place. I really agree with the messages and focus on quality bonds today. I was speaking to a number of end clients in Colorado Springs, right? A group of retirees actually, and I asked them. The math doesn't quite work this way, but I asked them, would you rather get, 0.1% on $10 or 5% on $8? And they're like, oh, I'd rather get the second.
Yeah, right.
So that's sort of the adjustment that we saw, right? And so high quality bonds today can play a role that is traditional in sort of a longer investment career, but hasn't been available for 10, 15 years. I think that positive correlation between stocks and bond prices that we saw in 2022, the only way that continues is if you get runaway inflation from here. I don't expect that. I think if there is to be a recession, bonds are going to help cushion that blow in a way that they can now because 2022 was so unfortunate.
Right, exactly. And as you mentioned, the CIO message and focus really taps into that idea. Thanks, Jason. And also, another thing I know you're talking about is diversifying beyond the U.S. and looking overseas, whether it's developed or emerging markets. Another one of our messages in focus. Do you see opportunities there as well?
Absolutely. The valuation gap between the U.S. and the rest of the world is really structural. So it's structural why? Well, the business models, particularly tech, tends to be a business model that affords a higher valuation, not because tech's amazing, but because it's sort of a recurring revenue stream. Microsoft's a great business. And it's a less cyclical business than maybe some others. So there is always this valuation gap. And I know a lot of folks have heard, hey, invest internationally for a long time. And the US has been pretty dominant. If you look now, even at sort of like for like within an industry, let's take energy as an example, the valuation discount outside the US is pretty significant. So I think that's interesting. EM, I think, is a very challenging space. So we used to say brick, right? And that was like, hey, look, EM, brick.
That's right.
Well, I'm pretty sure that Russia's not the same, thankfully, as Brazil. But even looking at Brazil, China, or South Korea or South Africa, these are really, really different markets that afford the investor a lot of opportunity to actually get exposed to some interesting business models, some significant growth stories in various places.
And it even seems like the reopening of China that's been happening isn't happening quite as fast as maybe some had predicted, so maybe there's still time left for that.
China's obviously incredibly interesting, second largest economy. It dominates EM indexes, but it's really a place where you have some potential for secular growth. Geopolitical challenges aside, which you can't really put aside, but geopolitical challenges are real. But if you go back to that 2001, 2002 analog, if that's a reasonable analog, what you saw subsequently was a really nice tailwind for emerging markets, non-US markets relative to US markets as a result of something of a similar setup.
Terrific. Jason, I wish we had more time, but this is a great rundown of where your head is and where our investors should be thinking of putting their money to work these days. Good to see you. Jason Brady from Thorberg Investment Manager. Good to see you, Jason.
Thanks for having
We'll
me.
get you back again soon.
I love it.
Maybe not in the heat of the summer months in New York City, but maybe in the fall. Great. Good to see you. Thank you. And as always, if you have any questions about your portfolio, please speak with a financial advisor, and make sure to check out more information on our Insights website at ubs.com/views. Plus, take a look at our brand new relaunched social media page on Instagram called UBS Trending. There's a lot of great content up there, plus some episodes of content that we can't get to here on this show. We post it there on Instagram, so some never-before-seen conversations are sitting there for you as well. Thanks for joining, everybody. Until next time, I'm Anthony Pastore. We hope you have a great rest of your day, and remember to keep your eyes on what's trending. Thanks, everybody.